The markets sold off in the last couple of days. Actually, they're still selling off. I want to talk about the financial markets, their behavior, and the way we at Orange Capital Partners react to some of those behaviors. This is a Not Even Wrong podcast. It's September 3rd, 2020. This is Krim Delco. For the day, the fund is down 30%. The market's down about 4%. We are now, for the year, up 190%. And the market is up 7%. We're outperforming by 183%. The main driver of our underperformance in the last couple of days has been Tesla. In fact, we lost about 60% of performance. So we went from 250 to 190 within 3 days. And it's all driven by roughly 20% correction of Tesla, which, given the size of Tesla now, is a pretty big deal, of course. I just want to clarify that the reason we have such outsized swings now is because we're still measuring the returns as of our NAV, the beginning of the year. We're not adjusting anything. And since Tesla has grown so dramatically now, it is just a lot more than actually our NAV was at the beginning of the year. So now every move in Tesla makes a big percentage move in our fund. So what's happening in the last couple of days is, in our view, it's a correction that is driven by technical indicators in the market, by technical behavior of players. Probably somebody's blowing up somewhere. There is adjustment margin calls. Certain brokers like Robinhood probably don't have their house in order, so there's some adjustment there. I want to say one thing. It really doesn't matter to us. We are not going to spend time now trying to understand what exactly is going on. We've seen it many times before. You have massive swings, and then things have to readjust, and then the weaker players usually create trouble and havoc in the market. And this is a segue into what we actually think as Orange Capital Partners, as hedge fund managers. What is our role? How do we act within the context of financial markets? Why is it we pay attention to certain things and we don't pay attention to other things? Again, the purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. And I think it's very important for people to understand how we, in the driver's seat of Orange Capital Partners, how we feel when we have massive corrections like this. I think it's a very good lesson and worth listening to that for people. So when you're in that situation, or if you are in that situation right now, maybe you can get some clues of how you could act. So let's get back to the basics. The purpose of Orange Capital Partners is to generate wealth by investing in disruptive technologies with large impact. I want to go back to a paper that goes back to Milton Friedman. And he talks about intellectual work and what it actually entails. And intellectual work is really the creation of a theory, and then you build a model on top of that theory. You then formulate goals, and you find ways to measure those goals, and the goals have to be achievable. This is, in a sense, what intellectual work does. No matter where, no matter how, no matter in what context, this is what we do as investors. I think this is what artists do. This is what anybody does that works in a conceptual framework using our brains. And this is absolutely key. This is the first principle approach to what we do. It is the building of a theory and then building of a model. Our theory at Orange Capital Partners is based on 3 books, or 3 thoughts, which are comprised in those 3 books. One is The Innovator's Dilemma by Clayton Christensen. One is The Innovation Stack by Jim McKelvey, and one is 0 to 1 by Peter Thiel. Those are the 3 books those are the pillars of our theory. The model that we build on top of that theory is, well, how can we build a model for a disruptive technology, a company which generates wealth through disruptive technology with large impact? We have to build a model. You have to, in order to actually get anything or translate theory into practice, you need a model. And the model that we built is around the innovation stack. It's around the culture of a company to solve problems, create new problems, solve problems. It's around the competitive response that we expect such companies provoke in incumbents. And there's a couple of other things, but in general, those are the main pillars of our model, which again are based on the theory that I just discussed. And we test this model continuously in a sense that we make sure that, look, if we have an innovation stack, well, is it really an innovation stack? How can we test that? Well, we can look at, is there a cascade of problem solving, creating new problems? Is the narrative of the company and the incumbents and the managers, is it along the lines of an innovation stack? We can compare maybe with other companies like Jim McKelvey's Square and see, okay, is this a similar narrative? And then later we take Tesla, we can see, well, there is definitely an innovation stack being built. We have to be very careful here that, of course, sometimes you can have companies that have certain aspects of their behavior which looks a bit like fitting into our model. One example would be Uber, another example Slack, another example Dropbox. There are a lot of companies that fit into that model but then still don't fully fit and actually are absolutely not part of that model and don't fit into our theory and would not help us achieve our purpose of generating wealth by investing in technologically driven disruption with large impact. My point here is that you have to be very, very careful and very precise when you run the data against that model. And also you have to be open to continuously question the data. So for example, Uber does not have an innovation stack solving problems because the fundamental innovation stack that they should be building is to solve the problem with the driver, solve the problem with insurance, solve the problem with the car, and there's really no innovation there. So anyway, I just want to say that you have to be very precise when you run the data against the model. So the goal is to generate wealth, and that is fairly easy to measure because we measure mainly money. But I want to say just a few things about wealth. Wealth is defined as being resourceful. And resourceful is not just money. Money, of course, helps a lot. But I want to use an analogy. Somebody said during the COVID-19 crisis, the biggest luxury has been to have your own destiny in your own hands. And to me, that is resourcefulness. That is wealth. If you can control your own destiny. And for that, you have to, of course, have capital, but you also have to be flexible. You have to have a cost base, which is flexible. You have to have a lifestyle, which is flexible. You have to be surrounded by people that are resourceful. There's a lot of things you can add to the wealth experience. For example, through your work on a daily basis, you can surround yourself with resourceful people, and that will also make yourself resourceful. So I just want to say it's not just about money. There's a lot of wealthy people which, in my view, are not very wealthy because in the end, they're not very resourceful. You can measure that very simply. If you need help, they are not there to help you. Then, and somebody that cannot help somebody else is, in my view, not resourceful. Doesn't mean how much money they have and how much they're wasting on private jets and whatnot. Anyway, let's get back to now. We have now spoken about the Orange Capital Partners, the fund. Now let's talk about the financial markets. The financial markets are like an automaton. They're based on very simple rules, out of which very complex systems evolve. The rules are, there's three basic rules financial markets are based on. And I understand we can discuss this now at infinitum, but I think if you summarize financial markets, three basic rules. Number one, opportunity costs of capital. Everybody in the financial markets follows the same algorithm. Should I invest in A, B, or C? The Treasury gives me 1%, Apple gives me 10%, Tesla gives me 40%. Which should I invest in? This is the concept of opportunity cost of capital, because if I invest in A, I, by definition, have taken capital away from B and C, and therefore I have to weight the expected returns. Number two, risk adjustment. Of course, I can't just compare those returns without risk adjustment. And number three, I have to survive. Robustness is the fundamental theory of nature, of evolution, and therefore it's also part of us. What robustness means in financial markets is you have to survive. You have to survive downturns. Your leverage cannot be such that you get wiped out. Because if you're wiped out, then your purpose cannot be achieved. Notice that having said all of this, there is no discussion here of buying low, selling high, catching market sentiment, listening to TV anchors, or all that stuff. The business of hedge fund managers is to follow their goals by looking at their models based on the theory that they formulated. So they continuously have to make sure that their theories work, their models fit the data, and then invest accordingly. This is the business. It's not about listening to somebody on, God knows, Bloomberg TV or something like that. This is not the business. And this brings us to the last couple of days. We had sell-offs, which are driven by weird things in the market happening. I think Robinhood is just sort of summarizes everything. What's going on there is probably illegal, definitely unethical, stupid. It's the sorcerer's apprentice in action. It will cause havoc and volatility. I think financial markets, though, as a whole, have a purpose. And that purpose is actually the same purpose that we have at Orange Capital Partners. It's to generate wealth by investing in technologically driven disruption with large impact. This is actually what financial markets are optimizing for. So we at Orange Capital Partners, as well as the financial markets, are not in the business of trying to anticipate what sentiment Robinhood will have today or tomorrow, or which hedge fund is issuing what 13F, or whatever it is that people talk about. And oh, you know, Bill Ackman's doing this and that, and all that stuff. It's all gossip, nonsense. It creates no wealth. And financial markets don't optimize for that. And the same way, we are not optimizing for that. And actually, this gives us a lot of comfort that we as a fund have the same long-term purpose as the financial markets. That's why we're able to function within the confines of financial markets, because we share the same goals. Thank you.